Ticker symbol CVS has had a pretty rough 2024, and it is right now down around 18% in the past year. But today, we'll be looking at a clear market leader which pays a very big, juicy dividend. And could this be the perfect dividend play? Well, they have a very long-term dividend history, and right now they're yielding 4.6% for their dividend, at, of course, an attractive valuation. So let's take a deeper look into CVS Pharmacy. Of course, a pharmaceutical retailer company. In their annual report, they said that they serve more than 35 million people through traditional, voluntary, and consumer-directed health insurance products and related services. But what exactly does this mean? Well, in simple numbers, they have more than 9,000 retail pharmacy locations, more than 1,200 medical clinics, a leading pharmacy benefits manager, and even a dedicated senior pharmacy care business. So this company actually started with their pharmacies and they're expanding across the whole healthcare industry. One fact that I found extremely impressive in their annual report is that around 85% of the US population lives within 10 miles of a CVS pharmacy location. This is astonishing. However, it raises the question of what else is there for them to do to keep growing as a company when already 85% of the whole population lives within 10 miles of one of these centers. However, they do have a growth strategy, and it can be broken down into three major things. The first one being to deliver solutions that are more personalized and simpler to use. The second one being to digitalize solutions so consumers can receive care whenever, wherever, and however they desire. And of course, these two don't apply exactly to the pharmacy aspect of their business, but it applies more to the other branches that they're investing in. And number three is to expand into personalized, technology-driven care delivery. Now, of course, this company may seem extremely attractive now that it's fallen over 18% in the past week. However, their financials are looking a bit shaky. They have a return on capital employed of 6%, which is a bit scary. Why? Well, the reason why we look at return on capital employed is because a company should be able to have a return on capital employed higher than their cost of capital. The return on capital employed is 6%, and the usual average cost of capital for such a large company tends to be closer to 10%, meaning that this company could well be in the terrain of actually destroying value for their shareholders, which to me is one of the biggest red flags that a company can have. Now, they have a 5.5 times interest coverage ratio. I personally like to look at companies that have this ratio over 10. However, this could be okay since they have a very predictable revenue. Now, in terms of cash conversion, they're sitting at a very good ratio of 92%, and they have okay profit margin of 15%. However, their net margin is 4%, which again is very scary. But it's understandable since it's a retailer for pharmaceutical products, so it cannot have crazy high margins. But here's where CVS actually starts to get a bit scary, because you can see that their revenue has been increasing every single quarter for the past 3 years. However, their gross profit has stayed more or less stagnant, and their net income as well. It declines every once in a while, and it doesn't manage to grow in line with their revenues. Now, one thing that they have going for them is that they do have more total assets than total liabilities, meaning that this company is in a safer financial position than the one that I actually thought. Now, their debt is higher than their equity, however, their debt to equity is still in a pretty okay level. But when looking at their efficiency ratios, we can see that the return on invested capital is right now sitting just under 11% and is trading up and down depending on the quarter. Now, when conducting the fundamental analysis, this company actually gets 5 ticks out of 8. The first one being their low liability risk. I actually gave them a pass here since although they have a very low interest coverage ratio, their revenues and their net income are so predictable that they will be okay paying their interest coverage at least in the short term. As well, they do pay a very solid dividend and they have been increasing it for a very long time. These increases may be at risk, however, they have a pretty good history of actually paying them every single quarter. Now, in terms of organic revenue growth, they do meet this aspect as we have seen that they are actually managing to grow their revenue every single quarter. And I do believe that they have pricing power to some extent, even though you cannot actually charge extremely high margins for the kind of products that they do sell. I think that their existing moat and competitive advantage of, for example, that figure that we have seen that 85% of the US lives within 10 miles of a CVS pharmacy, that to me is as an existing moat, of course, since it means that they're already operating at such a big scale, meaning that they can buy in bulk, that their brand alone is already attracting millions and millions of customers, and that people will be willing to pay a higher price at a CVS than in a random pharmacy. Why? Well, because they're more trustworthy. Now, the points that I didn't like about the fundamental analysis were, first of all, their balance sheet. I do not believe that it was solid, since they're not actually able to pay back their short-term debt, only with their current assets. Now, although they have some sort of cash flow consistency, since their cash flows are not growing quarter over quarter, this to me does not classify as real cash flow consistency as the one that I would expect from other companies such as Google, Microsoft, or even MasterCard. However, when we look at their dividend, it actually looks extremely juicy. As we can see, their dividend has been increasing for a very long time. All the way since October 2021, it has been increasing every single quarter. All the way to the point where right now it's yielding a 4.59% dividend yield, which I believe that it is the highest dividend yield that we have seen in the past 4 to 5 years. And now their payout ratio is around 45%, which is nothing crazy, and I think it's pretty sustainable for a firm that has very low capex and very low R&D expenditure, such as CVS. And now when looking at a valuation analysis, this company right now is trading the lowest it has been trading in the past 4 years in terms of a historic PE ratio. Right now, it looks like it's trading at a PE ratio of around 9. And in terms of free cash flow yield, in 2023, their free cash flow yield was around 14.9%, which is extremely higher than the 3% long-term inflation rate, also implying that this company is trading at an attractive valuation. Now, in terms of risks and possible challenges, I do see that the worsening of the competitive landscape for CVS, so I put this at a 60%. And why is this? Well, this is mainly because CVS is extremely dependent on their brick and mortar stores. They rely a lot on face-to-face channels in order to sell their products. And since this industry has so much money in it, there are right now so many competitors which are starting to actually become pharmaceutical retailers, but selling everything online. These companies are right now building a brand for themselves. They're becoming more respectable, and every day they're posing more of a threat for CVS. So I know that CVS is actually investing in other types of businesses, but this I would consider as a huge risk. Now, I do not see any possible upcoming regulation changes, but in terms of performance, I do see a risk of them not meeting performance objectives, because their expansion route is extremely difficult, as they're not able to grow by opening new stores, since they've already pretty much saturated the US market with brick and mortar stores, and they have to find other ways of growing their revenues, which are not their core business, such as the other medical services that they were offering. And now in terms of economic downturn and market risk, I do not see any, since people will still need to buy pharmaceutical products at a CVS, even if there is a recession going on. Now, before moving on to the investment conclusion, please remember that I'm not a financial advisor and this is not financial advice, so please do your own due diligence. However, I believe that this company has a strong competitive advantage. However, in my books, they do not classify as actually generating consistent cash flows, and they do not have high return on capital employed, which to me makes this company not be one that I would be looking to invest in, and I will be staying away from CVS long term, since that low return on capital employed, and I am not a fan of that uncertain long-term growth trajectory, since it makes the company not be predictable. So thank you very much for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link in bio for a free stock if you join Trade Republic.